It's good to be back here again. We'll see if I can figure out how to run this. I put this up last year, and I'll put it up again this year because I think these Outlook meetings at the beginning of the year are always interesting, and when we get further on, I'll tell you what I said last year. It's always about exactly what happened in the markets. Someone at the breakout session asked me whether or not, or which market would be the best performing market internationally this year, and I said, it'll be the one that you would never think of at the beginning of the year, and it'll probably be something like Zimbabwe or something like that. So I'm not sure that we'll be able to invest there, but this last year certainly was a volatile year. We felt that in terms of all of our portfolios on the international front. I think that on a relative basis, the performance has been good, but certainly not on an absolute one. I think Peter's right, and a number of the speakers here have talked about diversification and the psychology of investing, and I think that over the last few years, it's become very, very important to think about your investment strategies over the long term. And I certainly do that in a portfolio context, trying to understand why we're investing in certain companies and what the return outlook is for that stock, and try to understand the movements in that stock as to whether or not it is simply market psychology or there is something fundamentally wrong with the company. Ultimately, fundamentals matter. It's what we look at. It's what we invest in. We're investing in companies, not markets. These portfolios are very bottoms-up driven, and it's a company-by-company decision analysis on whether or not we put it into the portfolio. Talk a little bit about 2011. I'm glad to see 2011 go. It was a year of ups and downs. I think my view of 2012, and we'll get into this a little bit more in a couple of minutes, I think that the markets over the next few years won't look dissimilar to what we had in 2011. A lot of volatility, a lot of uncertainty, a lot of noise in the financial press about what is going on to sort out the financial mess that we've created over the last 10 years, which came to light in 2008. Why do you invest outside of Canada, and why do you invest outside of the U.S. and the safe markets that we all know? Well, it's because it's where you want to make money. This is all about financial returns. Financial returns follow fundamental company growth, and that follows fundamental economic growth. Valuation has to be considered. You can't invest in markets simply for growth, and you can't invest in companies simply for growth. However, when you look at the valuations across the globe right now, they're pretty cheap. There has been the flight to the bond market over the last 2 or 3 years, which ultimately will change. And the risk premium that's being paid right now for equities is about as large as you can get. And we think equities across the globe, not just in emerging markets or in the U.S., they're pretty cheap. So I think that the outlook in general for the equity markets over the next several years, if I had to make a prediction, is that they'll continue to be volatile, but there's plenty of value out there for long-term investors to look at these markets and look at these companies and be able to invest for a long period of time. I always make the suggestion to people when you're looking at buying these funds or investing anywhere, and you're watching the financial press and the television, and you're going to make a decision about your portfolio, step back, take a deep breath, think about it for another couple of days, and see whether or not that's actually what you want to do, because these markets go up and down for no apparent reason. People ask me in the morning why things went up in China or down in China, and frankly, half the time, there's no real reason. The kinds of companies that we invest in, and in your portfolios, it's all about companies. The kinds of places that we like to invest in all of our portfolios, but certainly this one, are small cap companies. Kinds of companies that you get: Jubilant FoodWorks. It's a little company in India that is opening Domino's pizza stores across the country. You would think The Indians might not like pizza, but they love it. And it's quick to get to because it's delivered on a motor scooter, and the capital expenditure to build a new store in India is pretty low. So they open 80, 90 stores a year, and it's the kind of company that you find out there that's a very small company and will continue to grow for quite some time. They just got the franchise for Dunkin' Donuts, so we'll see whether or not the Indian population likes donuts. The financial industry across the globe has structural issues, or at least in developed markets, it has a lot of structural issues which have yet to be addressed. For the most part in this portfolio, we have limited exposure to the financial industry, except in what we consider to be high-quality asset management companies, like Partners Group in Switzerland. And they run hedge fund-to-fund operations and private equity across Europe. Really, really good company, which has continued to grow and do well throughout the entire financial crisis. Babcock, it's an industrial company in the UK. It's a global growth company, and that's part of the reason that you invest outside of Canada and the US, is to get exposure to ultimately better economic growth across the world. Dr. C. Labo, again, it's one of these little interesting companies. It's in Japan. Very difficult to find growth in Japan, but most of those growth companies are, in fact, small cap companies. Dr. C. Labo is a cosmetics company that is expanding into China and is incredibly cheap, as the Japanese market tends to be. If you look at performance, as I said, last year was disappointing. I think Peter would agree with that from an absolute basis. If you look back over the history of this product and our performance, we've outperformed in most environments. Hopefully this year will be a better year than last year from an absolute return standpoint. And as I say, the markets are particularly cheap, equities are cheap, and frankly, I don't see another down year in most of these markets. What worked last year was our investments in Japan and the UK, for the most part, in terms of relative performance. When you look at what detracted from performance against the index, frankly, it was an underweight in Japan. We should have had more there. But Japan, because of its diversification away from everything European, it was actually one of the better performing markets for us last year. So 2012. The risk for the upcoming year, I think, revolves around two issues. First is Europe, and the second is China. It's basically those two issues which will drive markets and returns outside of the US and Canada next year. For Europe, I think everyone has probably followed the financial press and understands that there is a significant, and probably more significant than the US, financial crisis going on in Europe, which revolves around whether or not the euro will survive. I will make a prediction this year that the euro will survive. A lot of the financial commentary is based on the belief that the political environment in Germany and throughout Europe will not be supportive of what needs to take place in order for the euro to survive. It's very difficult to analyze that, but if you have to make a bet, I suspect that the Europeans, and particularly the Germans, will ultimately do what needs to be done for the euro to survive. But it's going to be a very volatile environment in order to get that done. If you look back in the history of financial crises around the world, whether or not it's Japan, the US in previous years, Thailand, Indonesia, Japan, Korea, what have you, financial crises tend to come from banking systems which have over-levered themselves, which have, for whatever reason, been under-regulated or deregulated, and under-supervised. And that over-leverage in a financial system tends to always go into an asset called real estate throughout all of these countries. And what you find when you look back at all of these financial crises is that in every case, the government bails out the banking system because they have to. You end up with a fiscal crisis because of that. It oftentimes comes along with a currency crisis. I used to think the U.S., Europe was different, but frankly, they're no different. And what you find is that this financial crisis takes a period of time to work out. The politics are ugly, governments fall because of this, and it is very, very volatile for about 3 to 5 years following a financial crisis, while the politics sort out the economic issues about who's going to pay the bill. But ultimately, these things get resolved, the banks get restructured, the banks get recapitalized, and then these economies can grow again. One of my analysts was down in Indonesia this year and meeting with some of the companies down there and came back very, very bulled up on the real estate market and the whole economy in Indonesia and said, oh, the economy is great, people are buying apartments, the real estate environment is great. And I thought, my goodness, here we are in 2011, and I remember back in 1998 when this all imploded, it took 8 years for that market and that financial system to get restructured, but now it's booming. That will also happen in Europe and the U.S., but it's going to take a period of time. And right now, we're at the front end of that process. So my prediction is that last year, the kind of environment that we lived in last year, you're going to get more of the same in this year. Which brings me to what Peter was talking about and other speakers have talked about, of focusing on the fundamentals. Think about the long term in terms of your investments, because what I've learned over the last few years in particular is that you can't outguess these markets, and you can't trade these markets, time these markets, because you don't know which way these things are going to go. So you have to take a fundamental look and a fundamental view of what is going on in a country. Let me mention China just a little bit, because I think if you look at growth around the world, the growth is still in emerging markets. That's not going to change for some time to come. But growth in China has probably peaked. Certainly the model of an investment-driven economic growth model has probably peaked in 2011, where the reliance on fixed asset investment in that economy is probably on its way down. That will be difficult for commodities and more industrial intensive commodity, not necessarily oil, because energy use is still quite high in China. But industrial materials, I think, are going to have a difficult time, because that fixed asset investment growth rate in China has already peaked, probably for our lifetimes. That economy is evolving into a consumer-driven economy, as all other economies do as they develop, and that's not a bad thing. You can find a lot of investment opportunities to invest in these markets as they evolve, and we do that. What is apparent to me is that the risk of an implosion in China, again, when you look at the financial media, isn't that high. There isn't a financial crisis in China. However, it will slow. And I think that's something that investors are going to have to contend with all year. The stock market throughout 2011, particularly in the domestic A-share market, which we don't invest in, but which is an indicator of the sentiment in China, has gone to all-time lows. The valuations there are very cheap, and that market is probably a buy at this point. Our exposure, the portfolio holdings, sort of reflect what I was just saying. We're very positive on consumers around the globe, particularly in emerging markets. We are very underexposed to the commodities cycle in general, not necessarily oil and gas, but certainly in materials. And we like places that are relatively stable. So when you look at the UK, Japan, we have significant holdings there in companies that are exposed to that global growth cycle. Unfortunately, I am catching a plane, so I'm not going to have a breakout session, but we had one before, and I will just leave you with the conclusion that the reason to invest in these markets, as I said, is ultimately for returns. Returns follow two things. They follow economic growth and they follow valuation. In international markets, particularly in emerging markets, you have growth, you have fundamental growth, and you have cheap valuations. So don't ignore investing outside of sort of the places where you're comfortable and safe, because there are returns to be made there. Thank you.